If you've got debt, there's more factors than just your credit score, interest rate, or the term of the loan that will determine your ability to pay it off and stay secure and stable in your overall finances. I'm Justin Hitt with Sustainable Wealth Secrets. I have a program on debt management, and it's for high income professionals. This is a lot different than debt management for the average typical person. This isn't a Dave Ramsey, pay off all your debt, or Susie Orman, keep your debt manageable. This is how to leverage debt as a high-income professional in order to gain control of assets that cash flow. So here's an example. There's a big difference between taking out a loan and buying a car and taking out a loan and buying a rental property. The car itself will depreciate almost immediately once you take it off the lot. The rental property, while it depreciates immediately, you can gain cash flow from the rental of the property. The vehicle repairs actually don't offset the value of the vehicle when you sell it. So if you put a bunch of custom add-ons to your vehicle, it doesn't make it more valuable. In a home, though, if you have capital expenditures, like you put a new roof on it or you put new windows on it, there's a potential for that house, that rental property, to increase in value in the marketplace, yet the cost offset the taxes that would be due when you sell that property. A lot of folks have been talking about Donald Trump's finances and how much losses that he has. Well, as a real estate investor or a real estate developer, he potentially can write off a large number of losses legally based on how the tax system favors those who own businesses or those who invest in real property. And think about it this way. When you invest in real property, you're taking all the risk. Your renter takes zero risk. In fact, your renter has a problem with their, for example, one of my properties, the supply water line broke. We don't know why it happened. It just, boom, water springing up out of the yard. The tenant doesn't have to go find somebody to fix that. They call me. I'm responsible for fixing that. I paid the $6,200 it required to fix that. The tenant paid nothing. Their month-to-month cost doesn't change. In fact, as a tenant, they have more rights than a homeowner as far as safe and quality living conditions. So these people that talk about affordable rent and stuff, well, you know what? That rent's going to be market-based. And the cost of the home is going to be based on a number of factors, including the owner's credit score, interest rate on the loans, and term of those loans. Now, you may have a portfolio of debt, and I talk about the portfolio of debt where we're looking at our assets versus our liabilities, and you're managing this portfolio. You want to move as much of that money in that portfolio towards positive accumulation. And that's really how we build the net worth. Now, we can use debt to buy assets. And a home you live in is not an asset, by the way. You want to live in the smallest home, or even rent. Live in the smallest home or rent, and then put all your money into something else that cash flows. But for example, I did buy a truck that cash flows. The difference is the truck paid for itself in the sense that when I purchased the truck, I was able to buy it for less than Blue Book trade-in value. Okay, so that makes it temporarily an asset, but it becomes a liability as the loan is paid off and the utility value of the truck is reduced because the jobs that the truck was going to take care of are done in advance. A house, in a different sense, or a rental property or a retail space that you've purchased, maybe a shopping center, even a car lot or a laundromat or there's a lot of assets that cash flow that you can find out there. You can find a piece of land for cheap and then put a farm on it, for example, and take farming deductions. Now, again, a deduction, you've spent money already. A deduction actually just reduces your taxes, but not as much as you spent. So it's actually a debt ledger type item as well. But here's my larger point. If you have a portfolio of debt that represents positive net cash flow, so you buy a house for $100,000, you rent it for $2,000 a month, your cost on the property, the $100,000, let's say you have $1,000 mortgage payment and $300 or $400 in maintenance and repairs, you got $1,500 in the deal. You're getting $2,000 a month in rent. You got a $500 spread on that. You've got enough money from the cash flow of the property to cover the obligations for the property itself. Now, real estate's not the only thing. And at some points in life, I've had websites that paid for themselves. They actually generated revenue or generated contracts for service that produced enough net margin in order to pay for the webmaster and the articles and all the materials that went into managing the site itself. So you've got to look at this. If you're just looking at debt as something you have to get away from or you have to get out from under, you will not do the calculation up front to determine that, well, how can I make this money profit? How can I partner with a bank, a private investor? How can I partner with a seed fund? How can I partner with a tax deduction so that I can multiply these funds, this money available? And this is important with these PPP loans. I know a bunch of businesses that went out and got their maximum PPP loans. And the government's talking about, how do we help these businesses open? How do we get them the money they need? I don't think it's the government's place to be doing that. If private businesses do the math, they'll find the opportunity to get cash and turn that cash into more cash. And it is really that simple. If I had $1 million, what could I do to have $2 million? And you might say, well, that sounds kind of greedy, Justin. You already got $1 million. You know, what kind of greedy bastard are you? Well, if you think about it, when you go to retire, if you make $100,000 a year, and if 4% is your safe rate of return on money, that means every $1 million you have in the bank produces $40,000. So if you need $100,000 in retirement income, you need to have $2 or $3 million in the bank in order to produce that kind of return. And I know you're saying, well, Justin, I can make 10% on the stock market. I can make 10% a year on the stock. Well, still, if you need to make $100,000, you need to have $1 million in the bank if you can cash flow 10% off your money every year, which most people cannot. At least you can't do it safely year to year. My point being is, how do you get to that $2 million in retirement savings? How do you get to that $3 million in retirement savings? People are living longer and longer than ever before. The cost of healthcare is increasing. $1 million in the bank today has more value than $1 million in the bank in 20 years from now. Because again, we have inflation, we have the cost of goods changing, we have economic situations and surprises along the way. I wasn't expecting to have to spend $6,200 to replace a water supply line on a rental property. The rental property is already under some rehab, and it probably has another $30,000 in rehab. Its cost basis is $98,000. Its market value is $113,000. I can't add too much more capital expenditure on this property before its cost basis is the same or more than its market value. And if the cost basis is higher than the market value, then I've got to keep renters in the property. I can't sell it for a profit. I don't mind keeping renters in the property, but I don't want to load up the cost basis. And this is kind of the language and the mindset and the thinking process you have to go through. You don't want to load up the cost basis and improve the property too much, because then if you had to sell it, the economy goes south, the market conditions change, and the properties are in high demand. I want to get cash out of the property or get equity out of the property to go use for debt reduction. I want to go use it to buy another piece of property or a better property. I want to upgrade. These types of things you have to consider up front, so that rather than having debt that holds you down, you have debt as a foundation of your growth of net worth. Now, you might be saying, well, Justin, but that's a liability on my books. Well, it depends on how it's structured. Some liabilities for qualified real estate individuals, so let's say you got a real estate license, you could actually take your losses every year for the rest of your life, which means you could buy a property every year and be slightly underwater as you improve that property. Take that as a reduction against your taxes, so it reduces your tax liability. So technically, by being a little bit in debt to buy a property, you're a lot less in debt for your tax liability. And then overall start stacking these properties as they cash flow. You're now getting to a point where you can't take, the deductions don't have as much value, but your overall need to pay and the capital expenditures is much lower as well. But the long run, what happens is you've built that, you've ratcheted up those assets, and then once the debts are paid off, or the debts may never get paid off, you are essentially free and clear. Now, here's the thing. When I say the debts may never get paid off, okay, you're renting the property from the bank or buying the property with the bank. Does that make sense? Now, I use property as an example. It doesn't have to be property. It could be a piece of equipment in a business. It could be a certain relationship. It could be debt you borrowed at 2% that you invest at a steady 4% return. That gives you a 2% spread. Now, I know I'm using some terms and some concepts that may not be familiar with you. Please, if you have questions, raise your hand. Contact me at www.sustainablewealthsecrets.com. Any CPA you work with or any fee-based certified financial planner that you work with will be able to look at these numbers on a sheet of paper. And don't hide these numbers. You want to have a debt ledger. We talk about that in the debt management program. You want to be rolling over and bundling and reducing interest rates, bundling to reduce your cash flow obligations. You want to be taking this money in structured businesses or in real estate relationships or in partnerships. You want to be getting different types of funds. You want to stay away from credit cards. They are a very high interest rate. You don't have to use credit cards, but you want to be rolling this money around so that you ultimately pay it off fast. But you're always paying it off faster than the cash flow is increasing, because as Benjamin Franklin says, you can reduce your wants and increase your means. You can get just about any, and I paraphrase that, you can get just about anything you need if you have free net cash flow. You also are going to start building out reserve funds to prepare yourself for situations where you might get to the end of a loan and you've got a loan that maybe it's got $1,000 a month payment on it and you've just got like $6,000 left on the loan. And if you paid off the loan with cash reserves, you'd free up $1,000 in cash flow that you can then turn around and cover something else, or in 6 months recover your payments. But meanwhile, that $1,000 in cash flow is stacking in an investment. That's why our debt ledger actually is a cash flow ledger. It actually has your assets and your liabilities, because if you can have your cash assets earning more interest than your debt assets, then that's also a good position to be in. Again, if you have questions about this or anything else, I'm Justin Hitt with Sustainable Wealth Secrets. We help high-income homeowners, high-income professionals, entrepreneurs, and other folks who want to boost and grow their net cash flow as well as their net worth so that they can have what we are calling sustainable wealth, a principal in the bank that pays your every day, a security in knowing that you aren't going to be without money, and a position in life where, yes, a lot of people are going to look at you and consider you wealthy, but you're going to be able to do the things that you want to do. Be the person you want to be. If you have questions, you can visit www.sustainablewealthsecrets.com. Thanks for listening.